126 cars in a single quarter. Wall Street was expecting 406,000. That's a 25% jump year over year, one of the biggest delivery beats in Tesla's history. So why is that same Wall Street still modeling negative $3 billion in free cash flow for the exact same quarter? That's the number nobody's talking about, and it changes everything about Tesla's fight with BYD. This is RPMXE. In the next few minutes, I'm going to break down three things. One, the headline number, and why it's a bigger deal than most people think. Two, the number Wall Street isn't celebrating and what it says about Tesla's actual health. Three, and what this means for the one company Tesla can't stop looking over its shoulder at, BYD. If you want EV numbers decoded like this every week, hit subscribe. That's what this channel does. Let's start with what everyone's celebrating. 480,000, 126 vehicles delivered in the second quarter of 2026. Production came in above 450,000. Analysts had penciled in around 406,000 deliveries, meaning Tesla beat the consensus by roughly 18%. Year over year, that's up 25%. Quarter over quarter, it's a clean rebound from what many were calling a demand ceiling earlier this year. On top of that, energy storage deployments hit 13.5 gigawatt hours, a segment barely anyone in the mainstream car media covers, and we'll come back to why that matters. On paper, this is a monster quarter. Tesla stock ripped on the news. The bulls are victory lapping. The bears are quiet. But here's where it gets interesting. Now, these are the analyst estimates. Tesla reports the actual numbers on July 22nd. But here's why what analysts expect matters more than the number itself. This is the earnings consensus Tesla itself published, compiled from 23 of the biggest sell-side analysts on Wall Street. Goldman Sachs, Morgan Stanley, JP Morgan, Barclays, UBS. The names you'd expect. These are the numbers they expect Tesla to report tomorrow. Look closely. Total revenue, $27.58 billion. Down from Tesla's peak. Gross margin, 19.5%. Tesla used to run above 25%. That's a full 6 points of margin. Gone. Operating margin, 5.4%. That's not a growth company. That's a legacy automaker number. And the one that should stop you in your tracks, free cash flow, negative $3.25 billion. Let me put that in plain English. Tesla is expected to spend more cash than it brings in this quarter, by over $3 billion. Now, some of that is CapEx. Tesla is spending heavily on new factory buildouts, AI compute, and the Optimus program. Some of it is planned. Not all of it is bad. But here's the tension. Tesla just sold 25% more cars than the same quarter last year, and they're expected to make less profit per car doing it. Deliveries are up. Revenue per car is down. Margins are compressed. Free cash flow is deeply negative. This is what a price-cut-driven growth strategy actually looks like in the numbers. But there's one number in this report that almost nobody is talking about. And if you're actually trying to understand where Tesla is headed, this is the one that matters. Energy storage, 13.5 gigawatt hours deployed in a single quarter. That's up 40% from the same quarter last year and a massive 53% jump from Q1, which matters because Q1 was actually a scary dip for this segment. Tesla only deployed 8.8 gigawatt hours, and analysts started asking if the energy story was over. Q2 answered that question. This is now the second largest energy storage quarter in Tesla's history, behind only Q4 2025's record of 14.2 gigawatt hours. Tesla's CFO has publicly said 2026 will exceed 2025's total of 46.7 gigawatt hours. This is the part of Tesla that Elon Musk keeps hinting is underrated. He's not wrong. Energy storage runs at higher margins than cars, has no direct BYD-level competition yet, and the demand is being pulled forward by AI data center power needs. If you want to know where Tesla's next real growth story comes from, it's not the Model 2. It's not the robotaxi. It's the boring gray box in a substation somewhere. So, is Tesla winning or losing? Honestly, neither. Tesla is transforming. But there's one company that doesn't have Tesla's margin problem, doesn't have Tesla's cash flow problem, and is outshipping Tesla quarter after quarter, BYD, in pure electric cars. The apples-to-apples comparison with Tesla, BYD shipped 557,000 vehicles last quarter. Tesla shipped 480. That's a 77,000 unit lead, or 16%, in BYD's favor. And this isn't a fluke. BYD outsold Tesla by over 600,000 pure electric cars in all of 2025. If you count BYD's plug-in hybrids too, their total jumps to over 1.1 million vehicles a quarter, more than double what Tesla ships. Either way you slice the data, BYD is winning on volume. And they're doing it while remaining profitable per unit, because their vertical integration means they build their own batteries, their own chips, and increasingly their own ships to export. Tesla just posted a beat. BYD is quietly posting a bigger one every quarter without the headlines. The real question isn't, did Tesla have a good quarter? It's, can Tesla close the gap before BYD makes it uncatchable? That's the question I'm going to answer in the next video. 3 numbers to remember from today. 480,000, the beat. -3 billion, the hidden cost. 13.5 gigawatt hours, the future. Tesla reports the actual earnings tomorrow, and I'll have a follow-up video breaking down what they got right and what they got wrong. If this breakdown was useful, subscribe. I decode EV numbers like this every week. And head to the community tab right now. I've got a poll running on which rivalry I break down next. Your vote picks the video. I'm RPMXE. See you next one.